If we think about just the equity portfolio, how do you manage the risks within just the equity bucket?
Well, we look after the value fund for you, have done for about 14 years, and we've generated alpha there. We're not benchmark cognizant, so there are times that it underperforms and underperforms the peers. It had a great year this last year, not that it made money, but it didn't lose as much as everybody else, generating about 5% alpha. And yeah, we achieved that by sticking to the label. It's a value fund. We didn't have the growth stocks, and the growth stocks which have hurt us in our other portfolios. It's a focused portfolio of value stocks. And I think it's a nice point to mention that in the stable fund, the equities are designed, each stock is designed by each multi-counselor manager to suit the mandate of the stable fund. And it's not just a cookie cut of SA equities, take the same SA equities from the value fund and put those in the stable fund. Each stock there is low risk, trying to beat the CPI plus 4 mandate on its own, in its amalgam of those. But yeah, we're very pleased with the competitive return that we got from the value fund this last year.
In line with your long-term investment thinking, there's some names in the stable fund that have been there over 10 years.
Well, we take the Philip Fisher view on investing, and that is the only time to sell a stock is when you made a mistake buying it in the first place. And this business of reversion to mean and target prices and things like that, we haven't operated that way. So to some extent, we actually allocating our investors' assets to these management teams. And that's why we spend a lot of time worrying about management and what management's doing. So once we're in a good stock whose earnings are growing faster than inflation, then we want to stick with them through the overvaluation cycle. We might trim on the edges, etc. But generally, the stocks we got in all our funds, the stocks that we really like, have been with us for a lot more than 10 years. There's been some comment about our equity selection process, and we don't look at balance sheets. There's the stocks that blew up this last year were stocks that we've had for over 10 years with great management teams. Some of them, the management teams have stumbled. But the theme that tripped us up was we were unable to take advantage of cheap money globally, borrowing money at 1 or 2%. And we liked the fact that our companies geared up and borrowed at 1 or 2% and bought good assets, because that was a lovely way to take advantage of cheap money and grow their businesses, borrow money, pay back the borrowing, and you've got a much bigger business. And so we liked that. Unfortunately, some of the companies, the assets that were bought didn't work out so well. So that's a repeat, whether it's Aspen or BAT. BAT bought Reynolds from the Americans, and then the American government suddenly decided menthol is an issue, and that was 30% of Reynolds. So unfortunately, there's a couple of missteps by the management in what they bought. But I would point out that Richemont, which is also a big holding of ours, they borrowed at 1.5% in euros for the next 10 years, and they haven't spent €1 of that 10 billion euros they borrowed. So that one hasn't come through yet. But some of the others, whilst the theme was right and the principle was right and what we wanted was right, unfortunately the execution on part of those companies has had a bit of a damage in the short term.